Hello and welcome to Triffin Live. I'm Tash Courtney-Smith and today I'm joined by two incredible guests, Lizzie Lord, who is an investor at Piper Consumer Brands, and Franklin Martin, the co-founder of Triffin. And we're going to be talking about funding, which is a topic that comes up again and again and again in our world. Do you want to kick off by just introducing yourself and saying who you are and what you do? Lizzie, let's start with you.
Yeah, amazing. So I'm Lizzie. I'm an investor at Piper. I've been at Piper 2 years now. I came from PwC, background in financial due diligence, early stage corporate finance. Had a proper job for a short period of time at the Gym Group in their commercial finance team, and then made the jump into investing. Piper then, we're a consumer specialist fund, so all we do is invest in consumer brands. It's our 40th anniversary this year, so there's lots of grey hairs around the table, not necessarily mine, but from the wider Piper team. And where we come in is that growth capital. So we're private equity, ticket size anywhere between 5 and 20 million. Revenue stage probably coming up to that 10 million point. We can dip down a bit earlier. 14 in the team, so we're quite lean, and everyone wears slightly different hats. So given my background, my hat's more financial, business model, growth, exit. But we have specialists in the team, Leon, I know you know well, digital, people and specialists in brand as well.
And what are some of the most well-known brands that you guys have invested in? Because you've got a great portfolio, haven't you?
Close to my heart because they're two ones that I worked on. Most recent, Yard Sale, so that's a delivery pizza company, 14 you've had it nice, okay.
That's great.
Do some really interesting collabs, really interesting business model partners with pubs. Ancient and Brave was my first one when I joined
There's actually one near our office where we go for drinks.
What site's that?
We go to Photo Book.
Okay, the pub partner.
Yeah,
nice.
Yeah, it's really good. We like that.
Pizza and pints.
Exactly.
And then Ancient Brave was the first deal that I did when I came and joined
Wow, that's
Piper,
a great deal.
which is an amazing deal, and they're absolutely flying. Kate's amazing, the brand's amazing. They've got Davina on board as an ambassador, so it's just going really, really well. But we've got Wild Nutrition, another supplements brand. Neom, sort of known going into wellness now, but probably known for their lovely smelling candles and diffusers. Flatiron. So yeah, a real nice range, real nice mix.
Brilliant. Welcome. And Franklin, most people know who you are, but just in case anyone's watching who doesn't.
Yeah, no, good to be back and chatting again. So I'm one of the co-founders of Triffin, a finance platform for consumer brands. So we support a high number of brands in verticals like beauty, health, wellness, FMCG, apparel, accessories, luxury, and we help them manage and optimize their finances. And we've been on a mission to make capital more accessible to our customers, and so have recently launched a credit product, which we think is the most flexible and cost-effective form of funding for many of our customers.
Brilliant. When we were planning today's session, we were saying, is it going to be debt versus equity, or debt and equity, or capital and control? What do we call this? And I think, the reason we wanted to do this session is because this is such an important conversation for brands. I mean, Franklin, you're on the front line with a lot of brands. Talk about what you see from the point of view of brands and their funding and what they're looking for, and then the kind of decisions they have to take internally and the issues they have to work through that they may never have thought about before.
Yeah, so funding is such an important part of the success of the businesses we work with, and I'm sure the businesses that Piper invest in. And there's various paths that these businesses can take, and I wouldn't say there's one path for all. There's different considerations, pros, cons to raising equity versus being VC backed or PE backed versus bootstrapping. And for the customers we work with, we support everything from VC backed businesses through to bootstrapped, or the other way around, I should say, but everything in between. And so we see a bit of everything, and really kind of what we're doing is helping businesses be capital efficient, and whatever kind of funding situation they're in, we want to make that work as hard as it possibly can.
Great. And Lizzie, what sort of funding scenarios do you see in the brands you're talking to? I suppose they're probably coming to you maybe at a slightly later stage than they might be coming to Triffin, or there's probably some overlap there.
Yeah, so we come in at that sort of 5 million revenue as a very earliest point, so probably a tiny bit later than where you guys start.
But you have brands going up to 20 million, don't you, in the portfolio?
Absolutely.
Yeah, I do think in 25 it is probably more of a challenging equity raising scenario than maybe in previous years. I think there's still some uncertainty in the market, or some more sector agnostic investors have come away and out of consumer. So I do think it makes it a tiny bit more challenging, and maybe that's a good thing that brands are looking where else actually can they get that capital from. And I do think there's definitely a gap in the early stage equity market for consumer. There's loads of sort of B2B tech investors that come in at that really early stage. So a very short list of sort of consumer investors that actually come in at that point.
And what sort of misconceptions do you see from brands when they're thinking about what options they have for funding?
I think many brands think they have to raise equity.
Yeah.
And obviously, when starting out right at the beginning, most businesses need some kind of seed capital, and people sometimes raise friends and family rounds, that kind of thing. But I think a lot of businesses feel like they have to raise decent amounts of equity finance, either via VCs or get some P backing, as they go later. And I think it's amazing how far you can go almost without funding. I think there's definitely a time when you want to, I think maybe take a model that's working very well and then start to expand more quickly. And I'm sure there are the kind of opportunities that that Piper look for. But some of the fastest growing businesses on our platform, some of the most profitable businesses on our platform, are those that are really bootstrapped, haven't raised any money, and they're super lean, super agile, and really impressive businesses. They haven't needed the funding that other businesses have needed maybe in the past to get to the stage they get to.
I mean, I love those types of brands where they've done that, really leanly and really cleverly in their bedroom. Do you see or starting often from, say, bedrooms or their kitchens and then growing out, do you see a shift in kind of the approach of founders in terms of whether or not they believe they can bootstrap, or whether they all feel they still need to go for a big equity raise?
I think we see such a mix. So we do see brands come to us that haven't done a fundraise, that have got to that 10, 20 million pound mark. And I think that's super impressive. I'd say that's probably still on the rarer side.
Do you think it takes an unusual type of person to achieve that?
I think definitely a disciplined person.
Okay.
Every single penny needs to count. Every single digital marketing campaign that you do has to count. There's no sort of leverage for testing and going wrong, really. And maybe it sometimes takes a slightly longer period of time. Maybe that's not as attractive to VCs, but Piper, we're a bit more sustainable growth, a bit more steady. So that's definitely not something that would put us off when we're looking and assessing a company.
Okay, so we're going to talk about the two different types of funding: debt, equity, the pros and cons of both. Should we start with debt, Franklin, and you?
Sure. Yeah.
I mean, debt is such a controversial word, isn't it? In terms of some people understand, some people react negatively. Just talk about the landscape and how, why, when it's good and when it's not so good for brands.
Yeah. So I guess the first thing is that it is a broad landscape. If you think about the debt and credit products available at various stages of the life cycle of a company, they can vary significantly. So, you have everything from credit cards and traditional bank loans to bigger bank facilities, various types of revenue-based finance, invoice finance, inventory finance, and the list kind of continues going on and on and on. So it's not surprising it's actually quite a challenging landscape to navigate. And if that's not really your background, and you having things thrown at you, because
brands are having things thrown at them, aren't they? From in terms of offers of debt funding.
Absolutely, a combination of you might when you start hitting certain let's say thresholds, you'll have sales teams selling you financial products. You'll have probably emails from PayPal or Shopify and other kind of companies making money available to you. So more options available as you grow, harder to navigate. I think those options, if again you're not really kind of experienced in them, and even to compare actual costs of capital, align them to very specific use cases. The best finance operators in the industry do this very, very well, and for sure we see the most successful businesses leveraging debt and credit really efficiently, really well, and that can be something which helps them grow faster. In some cases, can actually increase profitability as well. I can speak about that. But it's something which to a lot of founders and early stage businesses is a bit of an unknown. Yeah.
And you've talked about good debt and bad debt. How do you categorise those two?
Yeah, I'd say sort of rather than just like straight kind of good and bad debt, I'd say it's more like how it's applied.
Yeah.
So starting with the bad, I think if you're a business that isn't profitable and you're borrowing money to really cover up gaps in profitability, that can be quite dangerous. And many of the businesses that talk about debt spirals and these kind of things, it's usually something related to that, where they're actually using debt for the wrong use case to actually cover up inefficiencies in trading or inefficiencies in their profitability.
And that's what is likely to lead to a debt spiral.
Yeah, absolutely. And if you think about some of the products that may be available to those businesses, for example, revenue-based finance, where they're taking a percentage of your daily sales, you could have a business that is maybe struggling or would struggle to repay those products in traditional terms, but because it's now available in a different structure, it can be available to them, but not always the best thing for the business. So that's an example of where I'd say debt is used in a negative way, and maybe what creates some of the the negative stories in the market, why people are fearful of it. On the other side, I'd say that when we see debt leveraged extremely efficiently, it's where it's really addressing the need to grow quicker, and that could be something as simple as expanding a retail and wholesale channel where there's demand for their products. Obviously, to grow retail and wholesale partners requires an upfront inventory cost. You have longer payment terms with the customers you'll be working with. And so that's the kind of, I'd say, use case where debt can be used very effectively. Also, if you have a lot of confidence in some of your core products and really looking to increase the amount of inventory you're borrowing, and obviously to grow, you need to buy more inventory and to spend more on marketing. But if you have, just some confidence in those products and the price at which you can acquire customers, if you're profitable on first transaction, these kind of things, there's a way that debt can be leveraged to perhaps bulk purchase inventory and reduce your cost per unit, and that's where you can actually use debt to increase profitability. We've actually built tools to help businesses do this. So as well as making capital more accessible to our customers, which has been our mission really, we've built tools to help them make informed decisions. And so that will be understanding things like fully financed cost per unit after taking debt to buy inventory, and understand the ideal length of term based on their inventory production lead times, based on their payment terms with their suppliers, and then based on their cash conversion cycles if they are a multi-channel business. So yes, so we're not just trying to make it available, we're trying to actually help businesses make the right decisions and access the right types of capital.
And I can definitely vouch that you do that as a company, because obviously we know a lot of brands, and I know a lot of brands that are on your platform.
We do, yeah.
And a few have said, have got themselves into revenue-based finance lending cycles, and then they've told me how you and your team have had to wean them off it. And they're very grateful for that.
Yeah, I mean,
even though it's like a process, they know what's happening. They're very grateful.
Yeah, I'd just say, for the past 2 years, we've just seen consistent bad experiences with all kinds of solutions in the market. And that is everything from big banks, whose products can be inaccessible and can be extremely painful and time consuming to apply for, right through to some of the more accessible options around whether it's revenue-based finance, inventory finance, invoice finance. But a lot of these solutions, I'd say, just from what we've seen from the customers that we support and work with, they don't really align with the business's needs, and often it can be a combination of accessibility, the application process, still quite old school, sort of offline back and forth. Sometimes the actual structures, the repayment structures, the term, they can be very expensive. All these things don't really align with the business needs. So we've tried to address all of those things with what we've launched. Yeah.
Great, brilliant. So Lizzie, when you first look at brands, I suppose you see brands in all sorts of different stages and with all sorts of different things going on. How do you look at debt when you see it in a brand? Do you sort of consider, is this something that's a risk to the brand or something that's helping the brand? What sort of assessment do you put brands through?
Yeah, I definitely wouldn't say it's a red flag if I see a brand that has got debt on the balance sheet. I would just be looking case by case and really understanding, okay, what are the payment terms? Are there any covenants? Can I line it up against a financial model and see what headroom there is under different scenarios? And just actually, is the size of debt the right size for the business? So I don't think there's a one size fits all. You'd have to just really look at it on a case by case and understanding those covenants.
And when you're investing in a brand from an equity point of view, what typically are you looking for the brand to have that makes Piper say, yes, we want this one?
Yeah, I think different people that wear the different hats will tell you a different thing.
Yeah.
Piper, we're completely brand obsessive. So I actually think articulating what is your better in difference, what's allowed you to cut through and will allow you to continue to cut through in 5 years to come, and hopefully 5 years onwards, because we want all our brands to do well after our Piper hold. So really understanding and articulating that. I'm more of a numbers person, so obviously I'm going to look at the numbers, and I think by the time you're at a Piper stage, you have got a lot of data to go through.
Yes.
So it's really understanding, okay, if you've grown really well, great, but why? What were the levers that got you there? really digging into the KPIs, repeat rates, cohorts, CAC to LTV, rate of sale data if you're in retail, like for likes if you're a site-based business, and thinking about what's that 5-year plan. So typically we hold businesses for a period of 5 years. What does that plan look like? How are you going to get there? That path to profitability is really important for us if they're not profitable today, or if they're at a lower EBITDA percentage today, what's that path to getting it to that, what we consider a long-term EBITDA percent?
And when you guys are investing and you're obviously putting money in for what, how do you take the decision in terms of what you're going to do with that brand? Do you have a kind of formula that works and is deployed across all brands? We're going to do A, B and C with our investment. Or how do you decide what you're going to do and what's going to move the needle? Because the one thing all brands want to know is, what am I going to do that's going to move the needle and be the difference that makes a difference?
Yeah. I think before thinking about what you spend the money on, it's making sure that you're raising the right size of money up front. So I don't think you want to give away too much equity just to sort of get more cash in the bank. It needs to be sort of the right amount.
Do you see brands coming in wanting, because a lot of brands go for big numbers when they're thinking, I'm going to do a raise, I'm going to raise 1 million, 2 million. They just pick big numbers, don't they?
Exactly. So I think it's our job to work with the brands to actually say, okay, can we work through the model, look at the cash flow? How much do you actually need now that's the right figure for you? Equally, you don't want them to raise not enough. You want a bit of a buffer. You don't want them to be going out back raising. Piper, we like to be the last ticket, but I suppose if it's an earlier stage, you don't want them back out raising in the market for 12 months' time.
Do you find they typically overestimate or underestimate what they need?
I think probably typically underestimate.
Oh, really?
Yeah.
Okay.
Yeah. I think there's always some sort of hiccup in the road, or there's always something you can try and test. And actually, once you've got that cushion of fundraising, it's quite nice to try and test some things that you haven't done before. But in terms of what we spend the money on, I'd say typically key hires. People are probably quite hesitant before they've got that cash in the bank to make those key, normally expensive hires.
Yes.
Building that great team around you will really help the business grow. Marketing, I think a lot of brands that we see are probably more leveraging digital marketing and that conversion. It's more you have the cash in the bank now. Let's think about top of funnel, brand. Is that out of home? Is that the right ambassadors? International is a big one that we see as well. So Piper, we're largely sort of UK and Europe focused, but a lot of our brands have a huge presence in the US. So it's, okay, that's going to cost a lot of money. How are we going to approach growing in the US or sort of any other sort of geographical international? That's, I'd probably say they're the key.
And they're all the sort of things that you wouldn't want to use debt for. So especially short-term debt, So I think, they're all strategic investments, things that may be related to R&D or strategically growing a company that there may be unknowns, like you say, and they're more relevant for equity investment than debt.
That's really interesting because a lot of people would use debt for marketing, for instance.
Yeah, and I suppose there's probably different.
And they might use debt for all of those things if I just think about the way I know brands think.
Yeah,
but you think those are not the right things to use debt for?
Well, just give a couple of examples. I think something simple like credit terms on advertising spend is amazing because it just means you don't have to pay straight away on a credit card for your marketing. You get slightly longer terms, and you can sell products and receive money before you have to essentially pay the bill on the marketing spend. If you're confident in your marketing performance and you can invest more doing that, then that's great. But I think where it gets risky on the debt side is when you're doing new things which are unproven and unknown, and it's quite possible that they don't work out. They don't go out as expected. And if you're expanding to a new market, let's say, or if you're hiring team members and you're actually borrowing money to do that, there's a good chance that those things won't work out. And so they're the things that I think you wouldn't really want to be borrowing money to do, or it's just risky to borrow money to do those things. A lot of it comes down to confidence. And if it's something which you've been running for a long time, you're really confident in your marketing performance, you've got just some good kind of I suppose baseline metrics, then credit for marketing can be really, really good, but in some cases you just wouldn't want to do it.
It's interesting you mentioned confidence because I was going to come on to psychology because the psychology around both of those things, taking on debt and taking on equity. What do you see that, because people can get alarmed by debt and worried about it, and then people also hear stories of VC funds coming in and founders losing control. I mean, how do founders navigate that in both of those scenarios?
Do you want to go first?
I suppose with various debt products, and again, this will range depending on the type of products available, but they'll carry different levels of security. And that can range from being completely unsecured to having company security and then also personal guarantees.
Yeah.
And so a lot of that it comes down to personal preference and what people are comfortable with, and again, how confident they are in the underlying business for some of those things. So there is a psychology, and probably the individual stakeholder would maybe have a preference for different options in those scenarios, but it's just something that they need to be informed about and consider for sure.
Brilliant. And what about on the equity side and
Yeah,
founders
I think it's really
fearing,
interesting,
they
that
want,
control point.
it's really interesting, isn't it? Because I think they definitely want a VC fund to come in and it's like the path, they succeeded, they're on this big mission, but then they also get worried, don't they, about, what if the fund takes over and what are we going to do?
Yeah, and I think it all comes back to picking the right fund. You're with this partner for 5 years, maybe a tiny bit longer. That relationship and trust is so important. Because I think there is a bit of a difference in sort of where founders have been able to, that haven't needed a sign-off before. When a VC or PE, especially that later stage comes in, they might need sign-off for stuff.
Yeah.
So I think it's having that trust, that relationship, and also changing that to actually we really want Piper's input on this. So using maybe key hires as an example, a classic investor consent right might be key hires over 100K, you need to get sign-off.
Yes.
Rather than sort of saying, oh God, that's control and it's a tick box exercise. Actually, can Piper help with a job description? Can we help with interviews? Have we thought about sort of the team structure in 3 years' time? And is that the right role, thinking from sort of looking back perspective? So hopefully what seems control becomes a bit more of a value add.
And a bit more collaborative.
Everything needs to be collaborative. And I think the thing with equity needs to come with expertise.
Yes.
That's my big view for equity.
And maybe it's just hard for some founders as they go into that to kind of release control and actually be like, okay, these people are here to help.
Yeah.
Because I know a lot of all the funds I know are really there to help.
Yeah.
They're not trying to have some sort of control mission. It's like they're here to help and help you achieve your goals, which you obviously want help for. You wouldn't have done the raise.
And Piper's super clear that we're non-execs. We don't run the business.
Yes.
So we put so much faith and trust, and I don't know the correct word to describe it, but in sort of either the founders or the CEO that is running the business. But I think that trust needs to flow both ways.
Brilliant. So our last question before we wrap up, which is quick fire. What is your best advice for founders thinking of funding, other than to obviously look at Triffin Capital, because it is just tell us some of the benefits of it in terms of its cost effectiveness.
Yeah, I mean, I guess the first thing we do is actually help brands understand how much they need and what they need that money for, and then connect them with the options that make most sense for their particular business, their particular use case. So now I think we're doing a really good job of that today, and obviously keen to help more businesses with that. I would say the advice, come back to your question, is just to be as informed as possible. And look at all the options and make decisions which make most sense for your business, but also for you as an individual stakeholder.
Brilliant. And Lizzie, what's your best advice for a founder looking for funding?
Yeah. I think just not have an always on approach, but I think go out and get to know investors. I think relationships are so important. It's so hard to get to know someone over a 3-month, 6-month fundraising period. Going out and build a relationship 2 years in advance. We invest in brands that we've met 2+ years ago, and we really like to sort of get to know them.
And I think that's definitely true about Piper, because you have a community, don't you, of brands that you nurture over the long term.
Yeah, hundreds.
Yes. I mean, how many are in the community?
I think probably 500+ we've got on our database.
But that's all about building that long-term relationship and trust, isn't it? Because I think it is difficult if you suddenly think, oh my goodness, we need to raise, and then you just go out meeting VC firms and you're just bringing someone brand new into a situation versus having a long-term relationship.
Yeah. And I think that also fundraising, it takes such a long time.
Yes.
And I think actually at the start of the process, there's time just getting to know funds. Actually, if you can do that years before you actually need to, that's one thing less that you need to do when you're actually thinking about fundraising.
Brilliant. Well, thank you so much, guys. Great conversation. And I hope everyone who's watching has learned about debt and equity. And thanks to both of you.
Pleasure. Thank you.